if you find a really good property now that stacks up and gives you what you want, as long as you're following my 5 golden rules from Property Magic, there's not going to be a problem. There's discerning type of clients, tenants who will pay you a higher rental income, a higher rent. Good thing about single lets, obviously, you don't pay the bills. The tenants have got to pay all the bills. So that's a real advantage there. I'm going to be the first presentation, all about the best strategy for the next 12 months. So my goal here is to really, in this particular talk for the next half hour, to really help you to get prepared for a recession. You know, the media's full of it. Everyone's talking themselves into recession. I think we are finally here. People I'm talking to are starting to feel it. And you need to know what you need to do, because what you've done historically may not be the best thing to do moving forward. Now, just kind of fair warning here. Nobody, not you, not me, nobody knows what's going to happen in the economy or to property prices. I would love to be able to say they're going to do this or that, but I don't know. Nobody knows, but history does leave clues. And what I'm going to do is be talking about the last recession and what happened then and the lessons we can take from that. Now, this is very important because it could make you or it could break you. I'm not trying to scare you. I'm just trying to tell you the reality of what is going to happen. The investing strategy you've used previously may not be the best to move forward with. So you need to be aware of that. And I'm going to talk about the market, the property market, and also at the end, I'd say, based on all of this, which strategies might be best. So that's just my opinion. You can agree or disagree, but I'll explain why, and hopefully you'll get it and hopefully agree with me. Now, during the last recession, many investors unfortunately lost everything. The last recession, I think, was very different to this one. The property crash started before the recession. That's kind of what brought us into recession. And it was all down to the global financial crisis. There was lots of irresponsible lending and irresponsible borrowing. But because property prices crashed, actually, if you knew what you were doing, it was a very good time to be investing. And many of my students and myself, who were still actively investing at that time, we did very, very well. Now, whenever you come to this, you might well be on my database, you might be on one of the other speakers' databases, so you may or may not know me. Can I give you a little tip? Whenever you listen to a presentation, whether it's a physical or online, whether you're on a webinar, whether you're watching a YouTube video, listening to a podcast, I think you should ask yourself the question, does the person speaking actually know what they're talking about? Do they have experience? Do they have track record? Because any idiot can put up a video on YouTube, and unfortunately many idiots do. So I think you should always ask them, who is this person? Just in case you don't know me, I'm going to very quickly take 1 minute to tell you who I am. So I started investing back in 1995. That's 25 years ago. And it's when I started work at Cadbury's in Birmingham, the chocolate manufacturer. I started as a graduate trainee, and as soon as I got a job, I bought a house for me to live in. And I rented out 2 of the rooms to my friends who were still at university. So I became a live-in landlord from 1995. Cut a very long story short, in 98, I bought my second house. I kept the first one. I then rented that from 1998 to students. So I've been a student landlord since 1998. And then I started to buy more and more properties. And by 2001, I was able to leave my full-time job. Now, I loved Cadbury's. It was a great company, great career prospects, you know, really nice people, fantastic product. But I just wanted a bit more freedom myself. And so I left in 2001. And then by 2003, so after 8 years of investing, I had fully replaced my former salary at Cadbury's. And at that point, I'd done pretty well from property, but I'd also made loads of mistakes because I didn't know what I was doing. None of my family ever invested apart from their own homes, or my friends were working. So I was very much doing it on my own and felt very, very lonely. So back in 2003, I went online to see if there's some sort of group or club I could have joined for investors, and there was nothing. So I started the very first networking almost 20 years ago in 2003, and I called it Property Investors Network. Started one meeting here in Birmingham where I still live, but we now have 50 meetings around the country. And now my company, two of my companies, my networking and my training have actually been bought by another company. I'm staying on for a couple of years because I love what I do, and I'm helping to grow our business internationally. So we're going to be around the world in the next couple of years, which is a very exciting thing to do. And back in 2003, I realized actually, I love to teach people. And what I particularly love is you give someone an idea, you see you can change the way they think, their perception, they go out, they take action, they do the hard work, but they get some results, they come back, and I just get a real buzz out of knowing I've just been a bit of a catalyst to help that person change their life for the better. And then I got very serious about this in 2007. We launched our Property Mastermind program. It's a year-long program that helps people achieve this target of £50,000 income, profit within 12 months. We're going to have 15 to 20% of people hit it in the first year. Most people take 2 or 3 years to get there. But still, that's an income for the rest of your life. You don't have to take 10 years, 15 years to build a portfolio if you don't want to. I then wrote a book called Property Magic. It's a #1 Amazon bestseller. By the way, I recommend you have an action list, some pen and paper to take some notes and write some things down you want to do. If you read my book, Property Magic, I really encourage you to go back and read it again, because there'll be things you missed the first time round, or maybe you listen to the audio version. If you haven't read it, just go and buy it on Amazon, or go and get it on Audible, listen to it. It's a very simple, basic book, but it will change the way you think about investing. I'm still actively investing in property. This is a deal a few years ago. This is a large care home up in the Northeast. We bought it and turned it into 45 apartments. I don't sell any property to any of my students, by the way. I think that's a conflict of interest. Instead, we sold it to estate agents and the like. And basically, the reason I'm telling you about this one is it was a great project that was bought to me by someone else. So your network is incredibly important. Someone bought me this deal. They had the deal. They had this skill and experience. They just didn't have the money. They said, do you want to join venture? I said, yes, great, because I'd worked with them before. It was a great project. We make about £1 million from this. But I didn't have enough money at the time. Most of my money was tied up in other deals. So I went out to my network, found some people, they put all the money in. They all got a great return on their investment, got to look over our shoulder and learn from the experience. And the project made about £1 million, £500,000 for my partner, £500,000 for me. I paid the interest of the loan, made about 400,000 from it. The interesting thing about this is I didn't find the deal, I didn't put the money in, and I've never even been to the site. Now, I've checked it out, I've had people go for me, but I've never been. So you can absolutely invest remotely once you have a good network and once you have the right knowledge and skills. So networking is really, really important, guys. And then finally, again, through my network, I built a business called Crowd Property. You can hear more about Crowd Property later because it's a development funding provider. We've lent well over £250 million through that. It just started as an idea, and I got the idea by going to an event, a business event, and I realized that myself and other people were finding really good deals and wanted to fund them. There were people with money in the bank doing nothing, so we created a platform that takes care of this, and now it's a substantial lender in the development market. So that's a little bit about me. I just wanted to explain, look, I know quite a bit about property. I don't claim to know it all, but I've been doing this a very long time, and I've helped a lot of people like you to become successful investors. So what I want to talk about really is the next 12 months, what we think is going on and what it's going to mean for you and your investing. So very quickly, let's think about what happens in recession. You're very conscious of it now because you're here, you're an investor right now. You might not have been so conscious as an investor if you weren't investing the last time recession happened. Now, normally it's triggered by really high inflation and interest rates go up, which the Bank of England typically do to kind of control inflation. This slows business growth down. Confidence in the market declines. People are very careful with the money. They've got less money to spend. Let's face it, with high inflation, with rising energy costs, 80% increase in energy costs is crazy. Increased petrol costs at the pumps. If you go to supermarket, shopping costs a lot more. The official figure for inflation is like 10.1% at the moment, I think. I don't know about you. I think if you think it's more than 10.1%, just type in more into the question box. Type in more if you think actually inflation is a lot more than 10.1%. Okay. Yep. Lynn, Sarah, Rachel, a lot of people saying more than 10%. Okay, so what this means is the average person, they got less money in their pocket. Okay, they got less money to spend on services and goods, and that means that businesses are going to sell less, they're going to decline, and they might make people unemployed. This isn't good because people are unemployed, they can't afford to pay their mortgages. Some of those properties might come onto the market, okay? So recessions generally are pretty bad for most people. And we've got this compounding effect of, because of the pandemic, there are still supply chain issues. So there hasn't been as much stuff. That's why prices have gone up. We then had the terrible war in Ukraine, which is still going on, obviously, and that's had a massive impact on petrol prices, on fuel prices, etc. And I think for the average person, this fuel prices are going to be a real challenge for many, many people. Now, the last recession we had was back in 2009. That's the official figures. And what happened back then? Well, basically, in the early 2000s, the property market, as you may remember, was absolutely booming. There was lots of irresponsible lending and irresponsible borrowing. What I mean by that is, literally, if you could fog up a mirror, if you could go and put fog on a mirror, you could literally borrow money to invest. It was absolutely crazy. We had what was called self-certification mortgages. That's where you just signed to say you could afford it. I had some buy-to-let mortgages that were 90% loan to value. If you were buying your own home and you had a good income, you could get 125% mortgage. So you're buying a house for maybe 200,000, you get a mortgage for 250. Crazy lending, crazy borrowing. And what happened in America in the mid 2000s, all the banks had taken this debt and sold it onto other banks as derivatives. And someone realized that actually some of this debt was never going to be paid back. It was supposed to be secured against property, but it would never be paid back. So it started in America with Lehman Brothers, came over here. You might remember the queues of people around Northern Rock trying to get their money out. The bank had to step in and they had to bail out Lloyds Bank and RBS, etc. It was an absolute mess. And because of that, the property market started to crash in 2008. I mean, the price had been booming, there were way too much, and it just needed to correct. And then as a result of that, the recession actually started in 2009. Now, in some parts of the country, typically Northern Ireland and some parts of the north of England, where price had always been much lower than the south, because of buy-to-let mortgages, that the market had literally exploded, had massive growth up north in the early to mid 2000s, and some of those were way overvalued. And so those areas were the hardest hit, and sometimes as much as 33% fall in property price. Now, the average was nowhere near that. The average was maybe like 15, 20%. Some places only 10% dip, okay? But it was pretty bad for many, many landlords. And the point you need to know here is many landlords remember this, okay? Many landlords remember this dip, okay? Now, I think right now it feels very similar to how it felt in the back end of 2007, 2008. That's when I was actually writing Property Magic. And it felt it feels similar to me, although it's a different circumstances. The property market was crashing in 2008, obviously. It was a great time to buy, but most people were very fearful. They didn't know what was happening. You know, they thought prices would keep going up, and that wasn't happening. People were losing properties. It wasn't good. Now, what does this all mean for you? What's happening right now, and what does it mean? So let's bring it back to what's happening now. So we think about landlords, right? I think one of the biggest concerns for landlords at the moment is rising interest rates. For the last 10 years or so, the Bank of England base rate was 0.5%. And many people, if people bought property before the credit crunch, they might have been on a mortgage where their interest was Bank of England base rate plus maybe 1 or 2%. So for many, many years, many landlords have had very good cash flow from their property. In fact, let's be really honest here. If interest rates weren't so low, many of the properties bought in the mid 2000s, they probably weren't great deals. They probably didn't really stack up. People were buying because they thought they'd keep going up. They weren't looking at the rental income. It's one of the reasons I wrote golden rules in Property Magic. Rule number 3, you've got to buy for cash flow, right? So anyway, a lot of people were probably saved by the fact that they had these low interest rates. And landlords have become very, very used to this. But as we've seen this year, interest rates have gone up and up and up and they keep going up. And I believe they're going to go up more before the end of the year. And so what this means is that many landlords, the profit they made, the monthly profits are being squeezed. So they're making less money now than they have in living memory anyway. There's also this double whammy because many landlords are being hit by Section 24. Now, this came in a few years ago. Back in April 2017, the government introduced Section 24, which was a change in the way that we as property investors are taxed. The very quick summary here is if you own property in your own name, which was very much the way the majority of people did. Nowadays, most people are putting property into a company because a company is not affected by Section 24. There are now a lot more mortgages available to companies, etc. But back in the day, buying in your own name was definitely the best way to do it. So if you own property in your own name, first of all, if you had mortgages, which the vast majority of landlords do, and if you're a higher rate taxpayer, which many landlords are, because they might have a business and a job and their property, high rate taxpayer, it means you pay a lot more tax. Now, what you need to understand is normally tax is what you pay on profit, right? You make some money, you got some cash, you pay tax on that. The way the Section 24 has planned the tax schedule, which is very clever really from the Chancellor's point of view, is that you can have a property that's not actually giving you any money. It's giving you no cash flow, maybe because the interest rates have gone up, so it's eating into your cash flow. And yet, because we are not allowed to offset all of the interest against our rental if you own it in your own name, in theory, you've made a profit. So you might have no cash, but in theory you've made a profit and the tax man is going to want their tax. So this is the real problem affected by many landlords. Now, many landlords have already sold, or they've incorporated into a company. Some, they only have a couple, they're lower rate taxpayers, they're not affected, etc. But this is becoming a problem for more people. Also, we have increasing legislation. We're hearing that, the EPC, the energy performance certificates, by 2025, we're going to have a C rating on all the properties. I don't know about you. I've got maybe 1 C. Most of mine are Ds on my property. So I'm going to have to spend money to bring them up to scratch, which is fine, but it's money that some people don't have to spend. We had the abolition of Section 21, which is how we get bad tenants out, etc. So all these changes, you can see how many landlords have experienced this and had amazing capital growth over the last 12 years, might be sitting there saying, you know what, maybe it's time I retire. Maybe it's time I sell up and get out of the industry. Now, at any time, there's always people who are coming into the industry and there are always people who are exiting the industry. That's always going to happen, right? But now we're seeing more and more landlords wanting to exit the industry because of all these things. They're making less money, all this increased legislation, and ones who remember the last crash and looking at what's going on, going into recession, I think many of those might be fearful of properties dropping and might decide they want to cash in on their properties. Now, this is just my view that I believe, but quite a few people, we've had people like Paul Champlainer from Landlord Action on the last one of these we did, and Sally Lawson, who's a former president of ALA. They all believe the same thing, and they are seeing the same thing. More and more landlords, more than ever before, are looking to sell their properties. Now, with all these landlords looking to sell, not every landlord, but there are, I think, over 2 million landlords. If 10% of them decide to sell up, or even just 5% of them, that's 100,000 landlords, which could be hundreds of thousands of properties which could come onto the market before 2025, before these costs for EPCs are required. So just think about that. If all this property comes onto the market, a lot of it is on already, but a lot of it comes on, will there be an oversupply of property? Or will the supply be soaked up by the underlying demand? Because I want to make it really clear. And by the way, I don't personally think there's going to be a big crash. I absolutely think there's going to be a correction, but I don't think there's going to be a big crash. It's just my two. Now, I could be completely wrong. I have no idea. That's just my gut feeling here. But here's the thing. In the UK, we do not have enough accommodation. That's why prices generally go up in the UK, because each year, you can go and Google this yourself, the government says we need 300,000 new homes but we only have about 200,000 built every single year. So there is a shortage every single year. Now, supply and demand goes up and down. All markets are cyclical, just like property. And so I don't know, but I want you to think about, if all this property does come on the market, is there going to be an oversupply? Will those landlords who remember the last crash be fearful and thus be prepared to sell their properties at a discount, a 10, 15% discount now, just to get rid of those properties? As I said before, I'm actually selling a couple of my properties, ones that are not such good. I'm keeping the really good ones, obviously, but ones that are not so good, I'm selling them, paying my tax, taking the money out, and I'm getting a cash buffer ready for what I believe is going to be some great opportunities. I don't think the market is going to have a massive crash. I do not think that. But I think a lot of landlords might believe it could happen, and so they're going to be more motivated to do better deals. If that makes sense to you, that's just my view. If that makes sense, in the question box, just type in MS. Just type in MS if that makes sense to you. Okay. Dan saying great insight and content summary. Thank you very much, Dan. I'm just sharing my view. I don't know if I'm right or wrong. We'll have to see. Okay, lots of people saying MS. So Rebecca, James, Helen, Dan, Erin, Teresa, Anthony, Suki, Catherine, Jill. Okay, right. So I'm just sharing my views with you guys. So I think there's going to be I do believe we could be coming into the buying opportunity of this decade. Every decade, there's normally a good time to buy. In the 90s, it was 1998 when I bought my second property, and I didn't know this at the time. I missed this opportunity. Buy-to-let mortgages were just coming out, and that was an amazing opportunity to massively scale up your portfolio in the end of the 80s, end of the 90s, early 2000s. I was buying, but I kind of missed that. I didn't know then what I know now. The next opportunity I was ready for, 2008, 2009, prices came down. That was an incredible buying opportunity. It was a bit scary at the time, I must admit, but we held the faith. Our students were buying, and everyone who bought then correctly did very, very well as a result of that. And I've been expecting to have another correction coming. I thought it was going to happen when COVID hit. I was actually wrong then, but I'm pleased it wasn't just me. The Bank of England also thought property prices could come down 16%. And that's why the government stepped in, and very wisely, they brought in the stamp duty holidays. They brought out the bounce back loans. Many people use those for property. They shouldn't have done, but they obviously did. And also they brought in furlough to stop millions of people being unemployed. They extended that several times. So the government reacted really well. And it's going to be really interesting to see which new leader we have of the Tory party, because depending who we get, they might have a different view to how they support the property market or not. So that's going to be very, very interesting as well. But I'm just saying, guys, this time of uncertainty, and it is uncertainty and it is scary. I get that. But I want you to see beyond that and recognize it could be a huge, huge opportunity. Now, if people are wanting to sell, and some want to sell because they want to get out, some just want to get away from the hassle, I believe, just like in the last crash, we had a lot of people doing things such as vendor finance and purchase lease options. If you don't know about those strategies, I highly recommend you get yourself up to speed about those. I'm actually focusing on those on our Property Magic live event, which is next weekend. We pretty much sold out for that now. It's an annual event we do, but anyway, you're too late for that. But we do have some training coming out about purchase lease options. And sometimes people think they know about purchase lease options. My view is, if you haven't actually done a purchase lease option, you don't know enough about them. So I really would encourage you to tap into some of the free training we've got about that to bring yourself up to speed. They're not really a strategy. It's more of a tool that you can use to control property, to get cash flow and equity growth from property you don't actually own, which is pretty cool. Now, what I want you to remember though is, whilst everyone else is running for the hills, you could be absolutely clearing up here. Okay. Now, a couple of questions. Should I wait to buy? Well, that's pretty obvious, right? Well, if the market's going to come down, should I wait? And my view is no, don't wait. If you find a really good property now that stacks up and gives you what you want, as long as you're following my 5 golden rules from Property Magic, there's not going to be a problem. Now, let me just, I have recommended you go and reread Property Magic or listen to it again, or if you haven't read it, absolutely go and get it. But let me just remind you about the golden rules anyway. First is we always want to buy from motivated sellers, and landlords, some of them are going to be pretty motivated. Number two, we only buy in an area of strong rental demand, and lots of the UK has got really good demand at the moment, which is great. We always buy for cash flow. Unless it makes positive cash flow, do not buy it. That is not a good investment. We're buying for the long term. We can make money short term, but you don't really want to be flipping property in a market like this. And then finally, rule number 5, we need to have a cash buffer. Some money put aside to make sure we can cover any unexpected expenses and things that might come up. Okay, so that's really important to understand. If you follow these golden rules, it's going to minimize the risks and maximize your return. I know some people say, yeah, but Simon, look, if I buy now in the next 6 months here and the value comes down in 12 months time, surely, I've lost money. No, you haven't lost money unless you have to sell the property. But if you follow the 5 golden rules, you shouldn't be looking to sell. Rule number 2, you can rent it out. Number 3, you're going to make cash flow. Number 4, you're holding long term. Remember, the underlying trend in the UK is up. So even though we might get a correction, a great time to buy, hold long term, and that should come back up and give you good capital growth over the long term. So I believe if you find a good deal now is a great time to be buying that deal. Don't worry about, I'm going to wait till it hits the bottom of the market. I hear that so much. Look, Simon, let's wait till it hits the bottom, then we can buy. Can I let you into a little secret? The secret is nobody knows when it's going to hit the market. I mean, the market might not even go down. It might continue to go, I don't know, might continue to go up. And I know people who literally sold a load of property about 4 or 5 years ago, expecting the market to crash, think it's going to happen every 10 years or so, waiting to jump back in. And they've missed 5 years of incredible growth. So don't try and guess the market. No one knows what's going to happen. If you find educate yourself, do your due diligence, find a great property, take action, buy it. Don't and ah. If it works for you now, great, buy it and hold on and plan to have for the long term. So that's pretty much what I wanted to share with you today. So with all this in mind, what are the best strategies? Well, it's kind of common sense, really. You really want strategies that have high cash flow and also are recession proof. High cash flow and recession proof. So what might some of those be? Well, I think there are 2 strategies which I think are going to be good moving forward if we go into recession. There is a caveat to it though. So the first one is, I believe HMOs, houses of multiple occupation, where we rent out multiple rooms to young professionals, students, etc. Why is that good in recession? Well, people can't afford to live on their own in an apartment where they've got to pay all the bills and the council tax and everything themselves. Moving into an HMO is far more cost effective. Now, I just want 2 caveats here. One is there's a lot of HMOs in the market, and I think there's an oversupply in most areas. So you might think, why would you want to do it if there's an oversupply? Listen carefully. There's an oversupply of very average HMOs. Go online, go and check yourself. Go onto spareroom.co.uk, which is the website that most people advertise their rooms on. You'll see most of them are very boring, magnolia walls, IKEA furniture. It's all the same. Don't do that. Don't do that because there's competition. You're going to be competing on price with other people. That is not the way to compete. If you go high end, if you make the properties look amazing, make them very functional, great design, there's discerning type of client, tenant, who will pay you a higher rental income, a higher rent. And you'll have less voids, higher rent, and that helps cover the higher energy costs. Because the one downside to this strategy, and the next one I'm going to mention, is you generally pay the bills. So you absolutely should be putting your rents up in your HMOs. Talk to tenants about that. Talk about energy costs. Talk about being conscious of energy, and a little bit of education might also go a long way. I have things like a timer stat on my central heating, so it can't be on all day. It goes on a certain time. So things you can do to bring down the consumption of energy, which is a good thing anyway, but also to keep your costs down. And if you have a very high cash flow, excuse me, on my HMOs, I've got a very good cash flow. I can afford to have the extra energy costs. Now, I don't want to pay high energy costs, of course I don't, but I can cover it because I've got my really good cash flow anyway. Okay, so that's the first thing. The other strategy, which I think is a real boom industry, and I think it will continue in the recession, is serviced accommodation, otherwise known as short-term lets or SA, and sorry, or Airbnb. The reason that's good is, look, I don't know, I love to travel. I've traveled internationally a few times this year already, and it's so expensive, partly because of the cost of aviation fuel. It's so expensive. Hotels are really expensive. I think people, even in difficult times, they still need a break. They want to get away. They may not travel internationally as much as they have in the past. They might stay in the UK and have staycations here. That means there's a really good demand for short-term accommodation. And by the way, don't just have one type of tenant. Don't just have holidaymakers. You want to have property that works for business people and in workers as well. Really important. And it's cheaper, more cost effective for people to stay in an Airbnb unit than it is to rent a hotel. So where people are trying to save money, but they still need to be away from home, I think at the right location done correctly, service accommodation could be really good. So I just love your view on this. You might think I'm completely wrong. Excuse me. I have a frog in my throat. I've always been talking too much. I should probably learn to breathe while I'm talking. I would love, when I turn my sound off and just have a glass of water, I'd love you to type in the question box, out of what I've said, do you think HMOs is a good thing that you want to do? Do you think SA, put in SA or Airbnb, just type in SA if you want to do that. Choose which of those resonates best. Or you might say both, you're doing both, or do both, or you might say none, you might disagree. So if you think HMOs, put HMO in. If you think SA, put SA in. If you think both, put both in. Or if you disagree, just put none. And I'd love you to say what you think is a better strategy to use in a declining market. Just type that in. Bim says you need a vocal physiotherapy to protect your vocal cords. Yeah, I think I probably do, actually. We also drink water. I'm going to drink some water right now while you type in. I'd love your view, please, your opinion. And this is just your opinion. I've given you mine. I might be right, might be wrong. I'd love your opinion. And I'll tell you what the results are in a moment when I've had a glass of water. What do you think is a good strategy for you? HMOs or SA or maybe something else? What do you think? Just please come and type that in while I have a glass of water. Okay, I'm back. Some people say SA, co-living HMO. Yeah, that's when I say HMO, I do mean co-living HMO. I mean the higher standard HMO. Very, very important. Rebecca says SA is very time consuming. I completely agree. Let me give my view on these. I think both SA and HMOs are good, but they're different. The thing I like about HMOs is it's a more stable income, it's more predictable. SAs, you can have real peaks and you can have real troughs, so you've got to account for that. And SAs particularly, it is like a business. You know, if you go into, well, I think you should treat all of your property like a business actually, but particularly SA, you've got to really treat it like you do not want to be the person who is changing the beds and sorting out linen and stuff. That is not a good use of your time. You've got to put systems in place. You've got to invest. You've got to have a team there ready to help you out. Really, really important. So yeah, I completely agree with your point there, Rebecca. It's interesting. I think it's a lot of people saying both. I think it's a pretty even split between people about HMOs. I think I'm a newcomer. The buy-to-let strategy was where we were going to go, but I'm not so sure now, says Rachel as well. And look, you know what? Buy-to-lets used to be really good, but I'm not sure with the rising interest rates and things. So now, by the way, if you're right about interest rates, you can obviously fix your mortgages, and we're going to have a mortgage broker next. Morgan's going to be speaking for us. But you know what? I think it's really important to understand that you have the choice to fix your rates if you want to. But if we're coming in and buying, it's going to have a higher rate now than it was 6 or 12 months ago. Okay, so I'm not sure that single lets, they can work in some parts of the country, and rents have all gone up, but it's not much of a bubble. I'd like to have a much more cash flow so I can cover things. The good thing about single lets, obviously, you don't pay the bills. The tenants have got to pay all the bills, so that's a real advantage there. Okay, so guys, thank you so much for sharing your views. Really interesting, and I hope this has been really educational for you. Just so you know, Later in this year and a couple of months, we're going to be doing some training again about HMOs. We're going to be training about service accommodation. So if those are of interest to you, let us know, or keep in touch. You get emails and things about it. Come and listen, come and learn for free. If it's right for you, maybe come and get some in-depth training and coaching, because all these strategies, if we want to invest, you've got to learn how to do this properly. It's very expensive to try and learn by trial and error or trial and terror, making mistakes on your own. So investing in yourself is the best thing you can possibly do.
I do hope you got massive value from watching this YouTube video. I'd encourage you to click on the link below to come and do the online training with me. And I've got another video lined up for you, which I think is also going to be really useful, that you should watch once you've registered for the online training with me. So invest with knowledge, invest with skill. I'll see you very soon.